I'm joined now by Jon Gray, who's, of course, the president and COO of Blackstone. And Jon, you look at the results from the third quarter, and one thing that struck our eye was that credit has become the largest unit at Blackstone, even surpassing your alma mater, real estate. What does this say about the future of the firm and what it's going to look like?
Well, Sonali, as always, great to be with you. I'll come to credit in a second, but what I would say is we really had a strong quarter. We saw this broad-based acceleration. Most importantly, we delivered terrific appreciation, the most in terms of amount in 3 years for our funds. We deployed more capital than we had in 2 years, and fundraising was over $40 billion, taking us to over $1.1 trillion. The biggest component of that was the private credit area. And it definitely speaks to something powerful that's happening in that area. Clients really appreciate what we're doing in terms of delivering incremental return to them without incremental risk. I think it will continue to grow in terms of AUM overall. And it also speaks to the strength of our firm and the diversity, our big real estate business, our big private equity business, and now this credit business and what we're doing in infrastructure and secondaries. And that helps us weather difficult periods like the last few years. Overall, I think while you're seeing good results here, it's happening because of the recovery in the capital markets and really the focus for us in some great areas like private credit, like data centers, like energy and energy transition in India. So we feel good about where we're heading, but there's no question credit has really delivered for us and our investors the last couple of years.
Well, the other thing about private credit here is that it really drove a lot of performance through the last year. It's up more than 16%, almost 17%. Are those kinds of returns sustainable?
Well, I think we clearly have been in a really great period for credit, right? You had spreads that were quite elevated. You had base rates elevated, and both of those are normalizing. So there's some excess return that's obviously going to come out of the system. But the real question is, can private credit deliver a durable premium over liquid fixed income? And to me, the answer to that is yes. And that's because of the farm to table model, the ability to bring investors right up to borrowers and give that holistic experience and deliver a higher return to those investors. And so you look at what we're doing in private investment grade credit, primarily for insurers today. And on average, we've delivered 185 basis points of higher returns on A-rated credits. And to those insurers, they say, wow, that's really attractive. That's why you see our insurance area growing 24% year on year to $221 billion. And in credit overall, this $432 billion between corporate and real estate credit. So it's an area that has a lot of momentum. And I think secularly, you'll see big investors around the world continue to allocate not only to non-investment grade credit, but to this investment grade area also in the private space.
Jon, you recently saw one of your rivals strike a large deal with a large bank. This was a $25 billion deal to deploy capital alongside Citigroup. Wondering where you think the industry is going here. Can you see yourself doing a deal similar of that size?
Well, what I'd say is partnerships are things we obviously consider. We do have a bias generally to do things ourselves. But we recognize there are areas where partners can be critically helpful. In direct lending, where we have a $123 billion platform, that's probably not an area we would do it. But we've done partnerships in consumer loans and fund finance with certain financial institutions. And I think you could see us find some of those in areas where it will be much easier for access of scale with those partners. But overall, I think we'll continue to build things out. It speaks to our strength and reach, but it's definitely an option in certain areas.
I also want to turn here to private equity for a moment because we have a market that's been waiting for a faster pace of realizations. Wondering what your expectation is here for sales to pick up and the IPO market to open up at scale.
Well, look, realizations have been the one thing that's lagged, but we have a lot of optimism when we look out to 2025. And if you were sort of, drafting a recipe to think about realizations, you'd say, well, I'd love to see base rates come down. And we've seen both short rates come down. I think they'll come down further. We've seen the 10-year come down. You'd say, I'd love to see spreads tighten. And we've seen 100, 200 basis points of spread tightening in corporate and real estate. You'd love to see more liquidity in the market. Banks, clearly, you talked to a bunch of them this week, are becoming more aggressive in lending money. The commercial mortgage-backed securities market is up fourfold in volume this year, so more liquidity. You'd like to see a strong equity market, record highs this week. And then, of course, you'd love to see more IPOs, and that's been lagging. But when we look out, we see a pipeline that's picking up momentum. If you talk to the banks, their pipeline of large IPOs is double where it was 6, 12 months ago. And we're having real-time discussions on IPOs. They've gone from sort of the theoretical to the practical. Should we do this in February or April? And it's natural because as equity markets go up, it's like a magnet pulling companies into the public market. So I think we're starting to lay the foundation for a much better realization period. It will happen. It takes time. You tend to plant seeds first and then harvest, but we're starting to move in that direction.
Can you give us a sense of how big 2025 might be for a year? A lot of people across the street talking about that pent-up demand from firms to start to exit companies. Does that mean 2025 will be the best year since when? How many companies do you maybe have in your pipeline? What kind of scale are we looking at?
You know, it's hard to put a number on things. The key for our business is we've obviously focused on maximizing returns. So if market conditions aren't there, we'll be patient. But it's really about a path of travel. We saw M&A volumes fall 50, 60%, even more in the private equity space. Now, as I discussed, the conditions have improved, and I would expect a meaningful pickup next year in activity. And that's just the way things are. It can, ramp up over time. It's obviously a function of markets, but the direction of travel is there, and certainly debt costs coming down. If you look at borrowing costs to do a private equity deal, so to sell to another sponsor, probably costs 300 basis points less than it did at the height. Or if you were talking about doing a real estate deal, it could be as much as 300 or 400 basis points lower. So I would just say overall, it feels like it'll be a meaningfully better environment next year, but hard to put an exact number on it.
There are a lot of questions out there too on, you mentioned real estate, how much the industry is out of the woods after such a high interest rate environment, after that first 50 basis point rate cut. Do you see the pain easing meaningfully, or are we still not out of the woods?
Well, I'd say on real estate, we're clearly on the path of recovery. If you went back to the beginning of the year when you and I were talking in January, we said real estate is bottoming. We said it wouldn't be a V-shaped recovery, but that we would try to deploy a lot of capital ahead of that. And basically, that's what's played out. We've seen 3 quarters in a row where private real estate values have gone up. The public REIT market has moved up nicely. We have deployed or committed $22 billion in real estate, 2.5 times more than the previous year. And that's happening because cost of capital has come down. Borrowing costs have come down a bunch. New supply has come down. Investor sentiment has improved. The conversations with investors around real estate has really shifted from if to when. They're now saying, should I get in? Our bias, of course, is to move earlier. If you went back to the early 90s or after the global financial crisis, we've seen this movie before. Values fall, assets trade below physical replacement costs. That's when you want to deploy capital. Investors' natural tendency is to wait for that all clear sign. We think you're better off getting in earlier. That's what we're trying to do. Obviously, the office sector, which we've talked about in the past, has got a longer journey out of this. But overall, commercial real estate, as I said, is on that path of recovery.
I also want to talk about what's ahead. You mentioned the IPO market opening up next year. When we talk to investors here at Bloomberg, many of them say that they're concerned about the U.S. election. They're concerned about the volatility around it. I'm curious on how you think the election is going to impact investor sentiment throughout the rest of this year and perhaps even into next year.
Well, Blackstone, we try to take a long-term approach. So when you think about what's really going to drive value for our investors, we tend to focus on this mega trend in data centers and the power that needs to go with it. What's happening in life science, this cyclical recovery we talked about in commercial real estate. We think those trends are really important. The second thing I'd say on the election is we have a pretty divided electorate. We could end up all blue, we could end up all red, but even if it happens, it will probably be with pretty thin margins. And so it's going to require some compromise. And I think that's important to keep in mind. And the third thing I'd say on the election is obviously a lot of things are said during an election campaign. What actually tends to happen can be different. And so I think investors have to sort of modulate what will ultimately happen versus what's happening right now in the heat of an election. And that, I think, gives us this sort of long-term perspective and try to maintain equanimity through all this noise.
How are you sizing up the impacts that either candidate could bring to the market? What would be the biggest difference in your view if Kamala Harris were to win versus Donald Trump?
Well, obviously, there would be differences in the regulatory front, certainly in the energy front, where the vice president would be more focused on renewables, the former president more focused on hydrocarbons, tax levels. They have different policies in terms of corporate taxes, one talking about raising, one lowering them. And then the tariffs, obviously, with the former president discussing that quite a bit. So they do have different views on policies. The good news for us as a firm, we've operated in blue environments, red environments, purple environments, and we've delivered for our underlying customers. That remains the key, and I feel confident regardless of who wins, we'll do a great job for our investors.
Jon, for most of this year, many people don't realize this, but Blackstone has enjoyed a larger market value than Goldman Sachs, than Morgan Stanley, than BlackRock, and then Citigroup. What does this say to you about the future of alternative asset management and the premium you command in markets?
Well, we're incredibly proud of what we built here. It is amazing that we have nearly a $200 billion market cap. When I joined this firm in 1992, we were managing less than $1 billion. It's really a testament to the vision of Steve Schwarzman, the talent of our people, and our relentless commitment to delivering performance for our customers. I think it does say that alternatives are really coming of age, that investors are recognizing the importance of the strong returns we can offer across asset classes. It also speaks to the breadth of what we're doing. You know, the business started originally really in private equity, real estate private equity, distressed credit. Now it's brought into many broader strategies in terms of infrastructure, core plus real estate, performing credit, both investment grade, non-investment grade, and the total available market has really grown too. Institutional investors, now insurance companies, and individual investors. And a couple of those markets, insurance companies, individual investors, we're still in very early days as they start to migrate. So I think it's a recognition both of the scale of the market where it's matured to, it's a recognition about the potential, but also a recognition of our platform, what we do broad-based. The last couple of years have been a great example of that. The strength of our credit arm has really helped us. We're now going to be moving into an environment where I think equity ownership is going to be really helpful as well. And I think we're pretty uniquely positioned with our asset-light, brand-heavy structure and a business model that has delivered for customers. So we feel really good.
Jon, I have to let you go soon, but before I do, I have to ask about what these videos are about. You've become something of a social media sensation of late, from your running videos from everywhere from Bentonville to San Francisco to Boston. What do you get out of it?
So I give credit to the LinkedIn folks. Our corporate affairs team really pushed me about a year ago to go on LinkedIn. And I think like everybody else, I put some things on. And I was running in Sydney, Australia 6 months ago. And I normally send my kids a video just to remind them I'm somewhere in the world. And I decided to do one to post on LinkedIn. We did it. It had this great reaction. And we've continued doing that. And it's sort of fun. but it does have a purpose. It allows us to communicate with our people. It allows us to communicate with our clients and our shareholders. It gives them a message about some of the things we're seeing and doing. And it's a lot of fun. And I get the added benefit of being healthy too. So I think I'll keep doing it. At some point, I'll probably jump the shark and stop, but it's been a lot of fun.